Exchange rates are one of the most underestimated forces in international investing, not because they are unimportant, but because they are uncomfortable to think about. They sit outside company fundamentals, outside balance sheets, and outside most investors' sense of control. When returns disappoint in foreign markets, currency is often blamed after the fact, as if it were an external shock rather than an integral part of the investment itself. In reality, exchange rates are not noise layered on top of international investing. They are one of its core components, shaping both risk and return, in ways that reward understanding and punish neglect. At the most basic level, when you invest internationally, you are making two investments at the same time. One is in the asset itself, such as a foreign stock bond or fund. The other is in the currency in which that asset is denominated. If the asset performs well, but the foreign currency weakens against your home currency part, or all of that gain can be erased. If the asset performs modestly, but the currency strengthens, returns can be amplified. These outcomes feel arbitrary only when the currency exposure was never acknowledged in the first place. One reason exchange rates confuse investors is that they do not behave like traditional assets. Currencies do not compound in the same way stocks do. They do not generate cash flows. Over very long periods, currency returns tend to mean revert, reflecting differences in inflation productivity and capital flows, rather than exponential growth. This makes currency gains feel unreliable and currency losses feel unfair. But this perspective misses the point. Exchange rates are not meant to be return engines. They are risk redistributors. Currency movements reflect deep macroeconomic forces. Interest rate differentials, inflation expectations, trade balances, fiscal discipline, political stability, and capital mobility all influence exchange rates over time. These forces operate on different timelines than corporate earnings or sector cycles. This is precisely why currency exposure can diversify a portfolio. When domestic conditions deteriorate, the home currency may weaken, cushioning the value of foreign assets when translated back. What feels like volatility in isolation can become protection in context. Another common misunderstanding is treating currency effects as short-term speculation. Investors often ask whether they should bet on a currency strengthening or weakening. This framing is misleading for long-term investors. Most individuals do not have a sustainable edge in forecasting currency movements, and attempting to trade currencies adds complexity without clear reward. The more relevant question is whether currency exposure aligns with the role international assets are meant to play in the portfolio. Exchange rates should be managed structurally, not tactically. Currency risk also interacts differently with different asset classes. For equities, currency movements can cut both ways. A weaker local currency can benefit export-oriented companies by making their goods more competitive, partially offsetting translation losses. For bonds, currency risk is often more dominant because fixed income returns are lower and more predictable. A modest currency move can overwhelm years of bond income. This is why currency considerations are often more critical in international bond investing than in equities. There is also an important behavioral element. Currency-driven losses feel particularly frustrating because they appear detached from company performance. An investor may correctly identify a strong foreign business only to see returns muted by exchange rates. This can lead to abandoning international exposure altogether, usually after a period of underperformance. Ironically, this behavior often locks in the very currency effects diversification was meant to balance. Exchange rates test patience in the same way market cycles do. The choice between hedged and unhedged investments brings these issues into focus. Currency-hedged funds aim to neutralize exchange rate effects, delivering returns closer to local asset performance. Unhedged funds accept currency movements as part of the experience. Neither approach is universally superior. Hedging reduces volatility, but also removes a potential diversifier. It introduces costs and can underperform when the home currency weakens. The right choice depends on time horizon asset class and the role of international exposure within the broader portfolio. Perhaps the most important insight is this currency risk is not inherently bad. Unacknowledged currency risk is. Investors who treat exchange rates as an afterthought are constantly surprised. Those who incorporate currency exposure into their expectations are rarely shocked even when outcomes are unfavorable. The difference lies in preparation, not prediction. As global investing becomes more accessible and more common, exchange rates move from the background to the foreground of portfolio outcomes. Understanding their role does not require becoming a currency strategist. It requires recognizing that every international investment is a package deal asset plus currency, and deciding deliberately how much of each you are willing to hold. Because without that clarity, international investing feels unpredictable and frustrating. Whereas with it, exchange rates become just another variable to be managed rather than feared. And understanding how to make that management decision in practice. When to hedge, when not to, and how to align currency exposure with long-term objectives is exactly where we need to go next, by examining when and how to manage currency exposure intelligently. Because the goal is not to eliminate exchange rate effects, but to align them with your objectives and tolerance. The first guiding principle is time horizon. Over long periods, currency movements tend to wash out while the diversification benefit remains. For long-term equity investors, especially those saving for distant goals, unhedged exposure often makes sense. It allows foreign assets to behave differently from domestic ones during economic stress, providing a form of insurance that is only visible in hindsight. Short-term investors, however, may find currency volatility overwhelming because time is insufficient for reversion to matter. The second principle is asset class sensitivity. Currency risk matters far more in fixed income than in equities. International bonds have lower expected returns, so currency swings can dominate outcomes. For this reason, many disciplined investors hedge currency exposure in foreign bond allocations, while leaving equity exposure unhedged. This approach reduces unnecessary volatility where it is least rewarded and preserves diversification where it is most valuable. Home currency characteristics also matter. Investors whose home currency is stable, widely used, and structurally strong experience currency effects differently from those in smaller or more volatile currencies. Hedging decisions should reflect this reality. There is no universal rule. Currency exposure should be evaluated relative to the role it plays in preserving purchasing power over time, not in winning short-term comparisons. Cost and complexity must be acknowledged. Hedging is not free. It involves ongoing costs, potential tracking error, and operational complexity. Over time, these frictions can erode returns. Investors who hedge by default often discover that they have paid for peace of mind they did not truly need. Hedging should be purposeful, not reflexive. The most effective approach is consistency. Switching between hedged and unhedged exposure based on recent currency moves is a form of market timing, and like most timing, it tends to disappoint. Decide on a policy in advance, document it, and review it only when objectives or circumstances change. This transforms currency management from a reactive frustration into a stable component of portfolio design. In the end, exchange rates test an investor's acceptance of uncertainty. They introduce variability that cannot be controlled or predicted with confidence. Those who demand precision will find international investing uncomfortable. Those who design for resilience will find that currency exposure, when understood and respected, contributes to balance rather than chaos. If this discussion helped demystify the role of exchange rates in international investing, consider subscribing to stay with these long-form conversations that focus on structure over speculation. And leave a comment sharing whether you prefer hedged or unhedged exposure, and why, because that choice reveals more about your priorities than your forecasts ever could.